October 2025. Gold glitters near historic highs. Nations stockpile it. Investors herald it as the ultimate safe haven against the relentless erosion of paper currencies. It is the oldest form of money, the bedrock of value for millennia, seemingly more relevant now than ever. But beneath this shimmering surface lies a profound, deeply unsettling question. What if the bedrock cracks? What if the unthinkable occurs? Not a minor correction, but a catastrophic, systemic collapse in the price of gold itself? This isn't mere speculation about market volatility. It's an exploration into the very nature of trust, value, and the precarious architecture of our modern financial world. Gold, though officially sidelined, remains a powerful psychological anchor, a silent measure of faith or fear in the fiat system. To contemplate its collapse is to stare into an abyss, forcing us to confront the fragility we ignore daily. The consequences wouldn't just ripple, they would unleash a tsunami across global markets, reshaping economies and challenging our most fundamental assumptions about money. What happens when the ultimate fail-safe fails? The historical echoes are louder than you think. To understand the potential devastation of a gold crash, we must first grasp its peculiar, almost paradoxical role in the 21st century. It's the ultimate contradiction, universally recognized as valuable, yet officially sidelined by the monetary system. How did we get here? For nearly all of recorded history, gold was money, or directly underpinned it. Its physical properties made it uniquely suited, scarce, durable, divisible, portable, and intrinsically beautiful. From the Lydian staters, arguably the first standardized coins, minted over 2,600 years ago, to the Roman aureus, the Byzantine solidus, the Florentine florin, and the British sovereign, gold and its sister metal, silver, formed the bedrock of commerce. Their value wasn't decreed by governments. It arose organically from millennia of human experience. Rulers could debase silver coins by mixing them with cheaper metals, as Rome disastrously did, leading to inflation and ruin. But gold, resistant to corrosion and easily verifiable, largely retained its integrity. It acted as a discipline, a physical constraint on the ambitions of states. You couldn't simply print more gold mines into existence to fund endless wars or lavish spending. This discipline reached its zenith during the era of the classical gold standard, primarily from the late 19th century until the outbreak of World War I and briefly revived thereafter. Under this system, major currencies like the British pound sterling and, later, the US dollar were directly convertible into a fixed amount of gold. International trade balanced relatively smoothly because trade deficits had to be settled with physical gold shipments. It wasn't a perfect system. It could transmit deflationary shocks and limited a government's ability to respond to crises. But it provided an anchor, a shared global measure of value based on something tangible. The strains of 2 world wars and the Great Depression severely weakened the gold standard. Nations suspended convertibility to fund their war efforts, resorting to the printing press, the same temptation that doomed Rome. After World War II, the Bretton Woods Agreement established a new global order. The US dollar was pegged to gold at $35 an ounce, and other major currencies were pegged to the dollar. The dollar became the world's reserve currency, but it still had that crucial, if distant, link to physical gold held in Fort Knox. That link was decisively severed on August 15, 1971. Facing dwindling gold reserves as foreign nations redeemed their dollars for gold, President Richard Nixon unilaterally suspended the dollar's convertibility. The Nixon Shock, as it became known, effectively ended the Bretton Woods system and ushered in the era of pure fiat currencies, money backed by nothing but government decree and public confidence. From that moment, gold was officially demonetized on the global stage. It became just another commodity, like oil or copper, traded on open markets. Yet it never truly lost its monetary soul. Think about it. Why do central banks, the very institutions that manage fiat currencies, still hold nearly 36,000 metric tons of gold in their vaults as of our hypothetical present in late 2025? Why have they been net buyers of gold for over a decade, especially nations seeking to diversify away from the US dollar? Why, during every major financial crisis, the dot-com bust, the 2008 meltdown, the COVID-19 panic, the persistent inflation of the early 2020s, do investors instinctively flock back to gold and silver? Because gold, in the fiat era, plays a different but equally crucial role. It is no longer the foundation, but the ultimate fire escape. It's the asset you own when you trust nothing else. It's the barometer of fear, the hedge against uncertainty, the historical counterpoint to the ever-expanding universe of paper promises and digital entries that we call modern finance. Its price reflects not just supply and demand for jewelry or industrial uses, but the collective anxiety about the stability of the entire system. The vibrant market we see in October 2025, with prices sustained near all-time highs, isn't just speculation. It's a global vote of no confidence in the long-term viability of unanchored paper money. Now, let's engage the terrifying hypothetical. What if this fire escape suddenly burst into flames? What if gold crashed? First, we must consider why it might crash. A massive, world-altering discovery of easily accessible gold. Possible, but unlikely given geology. A new technology that perfectly replicates gold's properties or makes it obsolete. Perhaps in the distant future, but not imminent. The most plausible trigger in our hyper-financialized world wouldn't be a change in gold's physical reality, but a sudden, inexplicable evaporation of trust in its role as a store of value. Perhaps a coordinated dump by major central banks attempting to prop up their own fiat currencies, or the catastrophic failure of a major gold ETF or derivative exchange, revealing the vast disconnect between paper claims and physical metal. Regardless of the trigger, the immediate consequences would ripple through the financial system with terrifying speed. The first dominoes, miners, and paper gold. The most obvious victims would be gold mining companies. Their stock prices would instantly vaporize. Exploration projects would halt. Layoffs would be swift and brutal, devastating communities reliant on the industry. Simultaneously, gold ETFs, funds holding physical gold or tracking its price, would face a wave of redemptions. Funds like GLD or IAU would see their assets under management plummet, potentially forcing them to dump physical gold onto an already collapsing market, accelerating the fall. The complex web of gold derivatives, futures, options, swaps, estimated to represent a notional value many times larger than the annual physical production, would face an unprecedented crisis. Margin calls would cascade, bankrupting leveraged players and potentially destabilizing major exchanges like the COMEX. The phantom world of paper gold, built on layers of claims far exceeding the physical metal available for delivery, would face its moment of truth. Contagion spreads. Beyond gold. The panic wouldn't stop at gold-specific assets. Silver, often seen as gold's volatile sibling, would likely crash in sympathy, perhaps even more severely given its smaller market size. Other precious metals like platinum and palladium might follow suit. The shockwave would then hit broader commodity markets. While industrial metals have their own supply-demand dynamics, a collapse in gold, the ultimate hard asset, could trigger a general flight from tangible goods perceived as risky, hitting everything from copper to oil, at least initially. Central banks in crisis. The world's central banks, holding vast gold reserves, would see the value of a key asset evaporate overnight. While gold is often marked to market infrequently on their balance sheets, a persistent crash would force a reckoning. This isn't just an accounting issue, it's a credibility issue. If the asset historically held as the ultimate reserve proves unreliable, what does that say about the central bank's own stability and judgment? Could some central banks, particularly those with weaker finances, be forced to sell their remaining gold to cover losses, creating a doom loop? The geopolitical implications are stark. Nations like Russia and China, which have strategically increased their gold holdings, would see a significant portion of their non-dollar reserves wiped out, potentially altering the global balance of power. Currency chaos. The flight to... What? In a typical crisis, investors flee risky assets for perceived safe havens, often government bonds and the US dollar. A gold crash, however, presents a terrifying paradox. If gold, the ultimate non-state store of value, collapses, where does trust flow? Initially, we might see a frantic scramble into the US dollar and US treasuries, simply because they are the largest and most liquid markets. The dollar could spike paradoxically, causing havoc for emerging markets with dollar-denominated debt. But this would likely be a temporary, reflexive move. The very foundation of trust in any store of value outside the immediate fiat system would be shattered. If even gold isn't safe, can we truly trust government bonds backed only by the promise of future taxation and the ability to print more currency? The very problem gold was supposed to hedge against? A gold crash could, ironically, eventually undermine confidence in the safe havens themselves, leading to spiking bond yields and questioning the solvency of governments drowning in debt. Equity market annihilation. The impact on global stock markets would be swift and brutal. A collapse in gold signifies a profound risk-off event, a signal that something is deeply wrong with the foundations of the financial system. Confidence would evaporate. Investors would dump stocks indiscriminately, seeking the perceived safety of cash, at least initially. We could see a market crash mirroring or even exceeding 2008 or 1929 as the psychological anchor provided by gold is ripped away. Valuations built on years of low interest rates and fiat expansion would suddenly look terrifyingly fragile. The deeper crisis, the evaporation of trust. Beyond the immediate market mechanics, a gold crash in our current era would represent something far more fundamental, a crisis of confidence in non-state stores of value. For 5,000 years, gold has served as the baseline, the ultimate recourse when trust in political or financial authorities wanes. Its value, while fluctuating, was rooted in its physical reality and its historical role. The fiat system, dominant only since 1971, is a historical anomaly. It relies entirely on collective belief. Belief that the paper in our wallets or the digits on our screens hold value because the government says they do, and because we trust the government won't abuse its power to create infinite amounts of it. Gold's persistent value, even after being demonetized, has always served as a quiet counter-narrative, a reminder that value can exist outside state control. If gold were to inexplicably lose that trust, it raises terrifying questions. Does it mean that value only resides where the state decrees? Does it signal the final triumph of fiat money, where citizens have no alternative, no escape hatch from potentially inflationary or confiscatory government policies? Would the failure of gold push fearful investors towards other non-state assets, like Bitcoin, accelerating their adoption? Or would it frighten them back into the perceived safety of the regulated, state-controlled financial system? Strengthening the hand of central banks, and potentially paving the way for more direct control mechanisms, like central bank digital currencies. CBDCs? A gold crash wouldn't just be markets repricing an asset. It would be humanity collectively questioning its deepest assumptions about what money is and where value truly resides. The psychological impact could be far more devastating and long-lasting than the immediate financial losses. It would unravel the historical thread that connects our modern digital finance back to the first Lydian coin. Echoes of history, warnings for today. History offers no precise parallel for a sudden collapse of gold in a globalized fiat system. When Rome debased its silver denarius, leading to hyperinflation, gold held its value, eventually forming the basis of the new solidus under Constantine. During the Weimar hyperinflation, those holding gold or foreign currency survived, while those holding paper marks were wiped out. Even after the US confiscated gold in 1933, the metal retained its global allure. But what if that allure itself vanished? It would suggest a paradigm shift, a collective decision, or perhaps delusion that the anchor is no longer needed, that the digital promises of the fiat system are absolute. It might initially seem like a victory for modern finance, proof that we have moved beyond the barbarous relic. Yet, the lessons of Rome, Weimar, Argentina, Greece, and Sri Lanka thunder down through the centuries. They warn us that unchecked government spending, funded by currency debasement, whether physical or digital, inevitably leads to a loss of trust. They warn us that when that trust breaks, the system prioritizes its own survival over the citizens it ostensibly serves. They warn us that true wealth, in the final analysis, often resides in tangible assets or productive capacity that exists independently of fragile financial promises. A gold crash, therefore, might not be the cause of a wider collapse, but the ultimate symptom. It would be the canary in the coal mine, finally succumbing to the toxic fumes, signaling that the entire financial atmosphere has become unbreathable. It would signify that the unprecedented levels of global debt and the decades-long experiment in unanchored money have reached their inevitable breaking point. The fortress of the global financial system, as we observe it in October 2025, looks imposing. The lights are bright, the music is loud, the numbers on the screen keep climbing. But the foundations groan under a weight history has never before witnessed. A gold crash would be the sound of those foundations finally giving way, triggering an earthquake that could reshape our world. The ultimate irony? In the chaotic aftermath, as paper promises evaporate and digital systems flicker, humanity might find itself once again desperately searching for something real, something tangible, something trustworthy to hold on to. And perhaps, just perhaps, they might rediscover the enduring, albeit painful value of that ancient, gleaming, barbarous relic. The question isn't if history rhymes, but whether we are listening closely enough to hear the tune before the final, deafening silence falls.